Welcome back. This is the place where we ignore the headlines, tune out the hype, and focus on one thing only, where the serious money is moving. Now I want you to pause for a moment and really think about this. What would you say if some of the largest financial institutions on Earth, firms that manage trillions of dollars, were quietly building positions in a relatively unknown small-cap AI company weeks before the broader market even realized it existed? What if those institutions had already done their research, run their models, spoken to management, and decided this was worth accumulating before the retail crowd ever opened their trading apps? And what if that same company was projecting a revenue expansion so aggressive it would represent more than a 13-fold increase in just 1 year? Today we're breaking down that exact situation. The company is Datavault AI, trading under the ticker Dvlt. And what's unfolding here may be one of the most interesting AI accumulation stories in the small-cap market right now. By the end of this video, you'll understand what institutional investors likely saw, how the business model actually works, where the growth projections are coming from, and why timing might matter more here than most people realize. So let's start at the foundation. The financial trajectory Dvlt is guiding toward approximately 45% year-over-year revenue growth, alongside a projected 60% increase in EBITDA by 2025. Earnings per share growth is expected to approach 50%. Those numbers alone would attract attention in any sector. But here's where it becomes unusual. The company carries a beta of around 0.75 relative to the S&P 500. In simple terms, that suggests lower volatility than the broader market. That's rare. Most high-growth AI companies trade like roller coasters. They spike on excitement and collapse on fear. Dvlt, at least statistically, is attempting to build a different profile, high growth without extreme swings. Now let's talk about institutional behavior, because that's where this story becomes especially compelling. In a single quarter, institutional long positions reportedly increased by more than 365%. Net shares added exceeded 28 million. Total institutional ownership climbed past 36 million shares, and the number of institutional holders rose by over 50%. But here's the detail that stands out. There were effectively no institutional short positions reported. When major financial institutions are buying aggressively and not betting against the stock at all, that isn't random activity. That's conviction. Among the names stepping in were global giants like State Street Corporation, Morgan Stanley, and Bank of America VECA. Timing matters in markets. And the sequence here is interesting. Major positions were established before forward guidance was publicly lifted. In other words, research likely happened first. Positioning came next. Public narrative followed after. That's typically how smart money operates. So what exactly were they positioning for? The inflection point. Dvlt reported fiscal year 2024 revenue of approximately $2.7 million. Guidance for 2025 moved toward a midpoint near $39 million. That jump represents roughly a 1,300% acceleration. And this isn't framed as speculative concept revenue. The company has been converting signed agreements into recognized GAAP revenue. That shift from concept stage to execution stage is where many small tech firms either prove themselves or fail. Now let's unpack the business model, because this is where the strategic angle becomes clearer. Management describes it as a toll booth model. The simplest way to understand that is this. Dvlt doesn't necessarily create all the data flowing through the system. Instead, it builds and controls the infrastructure, the rails that allow data to move, be tokenized, be monetized, and be processed. When you own the rails, you collect recurring fees. That structure can produce higher margins and more predictable revenue streams compared to content-driven or ad-dependent models. Looking ahead, the company has outlined a $200 million revenue target for 2026. Notably, in a recent quarter alone, it signed approximately $49 million in tokenization and technology licensing agreements. That means a meaningful portion of the following year's target is already contracted. For a small-cap AI infrastructure company, that level of forward visibility is uncommon. And management isn't stopping there. Long-term projections extend toward multi-billion-dollar ambitions by 2027. The strategic vehicle for that expansion is what they refer to as full node deployment. Think of this as a distributed network build-out, expanding into up to 100 cities, with each city representing potentially significant annual monetization opportunity tied to high-margin data infrastructure. Rather than relying purely on centralized cloud systems, Dvlt is focusing on GPU-powered edge nodes deployed in key metropolitan areas. Initial focus sectors include finance and healthcare, industries where speed, security, and data integrity are mission-critical. Edge processing reduces latency. It enhances localized control. It can also create competitive advantages in regulated industries. Infrastructure of this kind isn't cheap to deploy, but once installed, it can create durable, recurring revenue streams. Now layer in intellectual property. During 2025, Dvlt secured multiple U.S. patent allowances covering areas such as audio synchronization, carbon credit tokenization frameworks, and marketplace integrations, including work connected to platforms like NASDAQ via NYIAX. Patents act as defensive moats. In a rapidly expanding data monetization environment, IP protection matters. It discourages direct replication and strengthens enterprise credibility. Security is another pillar. Through its Sanctum AI framework, the company emphasizes quantum-resistant architecture, zero-trust models, and tokenization at the point of origin. For enterprise and biotech clients handling sensitive data, security isn't optional. It's foundational. And once deeply integrated into an infrastructure ecosystem, switching providers becomes difficult. That's what investors often refer to as stickiness. Beyond infrastructure and patents, execution signals also matter. Management reportedly conducted an extensive global tour, securing agreements across Europe and Asia. The company showcased technology deployments during major live events, including activities surrounding Super Bowl 60, demonstrating platform scalability under high-visibility conditions. Strategic partnerships have included organizations such as NFL Alumni Health, and acquisitions like API Media Innovation have expanded technological capabilities. This suggests the company isn't just outlining slides, it's actively expanding footprint. On the market side, sentiment indicators began shifting rapidly. Retail discussion forums turned bullish within days of announcements. The company also structured warrant distributions, one warrant per 60 shares held with a strike price set at $5, aligning long-term shareholder incentives with aggressive growth targets. From a valuation standpoint, traditional trailing price-to-earnings ratios may not fully capture a company undergoing rapid inflection. Forward price-to-sales modeling against the 2026 revenue target paints a different picture than backward-looking metrics. Following mid-February announcements, shares moved approximately 11%, reaching around 79 cents. Now here's the bigger question. Is this the early stage of a multi-year AI infrastructure build-out story, or is it an ambitious roadmap that still needs flawless execution? Because that's the real dividing line. Institutional accumulation suggests belief in the former. Execution risk reminds us of the latter. As always, this isn't about hype. It's about understanding where capital is flowing, why it might be flowing there, and what assumptions must prove correct for the thesis to work. High growth, expanding contracts, infrastructure deployment, institutional positioning, patent protection, security architecture, those are the pillars. Whether they ultimately support a multi-billion-dollar structure will depend on delivery over the next several quarters. But if you've made it this far, you're now looking at the situation with context, not just headlines. And in markets, context is everything. Stay sharp, follow the capital, and always do your own due diligence. This is not financial advice.